Hello and welcome. My name is Joe O'Mara. I'm the Head of Aviation Finance with KPMG. And on behalf of KPMG and Airline Economics, I'm delighted to be joined by Peter Barrett. Peter is the CEO of SMBC Aviation Capital. He's joining us for the purposes of our Aviation Leaders Report 2024. And I should say we're recording this in late November. Peter, thanks as always for joining us. Before we get into the meat of the conversation, do you want to tell our watchers a little bit about SMBC Aviation Capital?
Sure. Well, first of all, Joe, thanks for the opportunity. It doesn't feel like 12 months since we last did this. So SMBC Aviation Capital is the second largest aircraft leasing company in the world. We have a fleet of over 900 owned, managed and committed aircraft. We're owned by two of the largest corporations in Japan. A very strong rating at a BBB+, A-, and we've a portfolio of young narrow-body mainly narrow-body aircraft leased to about 120 customers around the world, and 270 great people based in mainly in Dublin, but also in other offices around the world.
Oh, great, Peter. And maybe given that breadth of activity, let's start with your customer base. Can you talk to us about how customer performance has evolved over the course of 2023, and just what variances, if you're seeing any, across the various geographies?
Yeah, I think it's definitely improved over the course of the year. I mean, what you're seeing, that the post-COVID recovery really had momentum at the start of this year. It travelled around the world, so it really got momentum in Asia in particular. And it's been a strong year for our customers. So they're all busy. They are flying lots of passengers. They're looking for additional aircraft. They are, in a good place. Cash collections are very strong, and I would say now the recovery is pretty well, completed, or significantly completed in most parts of the world. Probably one of the areas you're a little bit lagging is probably cross-border business out of China. Domestic China is very strong. Cross-border is a little bit weaker than it was pre-COVID. But again, I think that's something that will probably recover over time as the Chinese economy and gets kind of back on its feet and people are traveling more there. But overall, airlines are doing well. They're making money and they're in pretty decent shape.
And maybe looking out across the geopolitical challenges we're having, or the macroeconomic environment, your outlook as you assess into 2024, considering customer performance and where it will go, are you more or less concerned than you'd be on any given year in relation to those challenges?
Not particularly, Joe. I mean, I think, there's always challenges, and I think we need to kind of remember that there is always challenges in the aviation industry. Clearly, the last number of years have been particularly challenging with things like Russia and the Russian invasion of Ukraine and COVID. I'm not particularly concerned. I mean, I think we're obviously keeping a close eye on the Middle East and the terrible events in Israel and Palestine. So I think there's always a sense of being aware and alive to these things. But I don't see it as any better or any different or any worse. I mean, I think what you will see is that it's kind of getting more back to normal. So I think you're going to see more. There'll be going to be some winners and some losers in different markets. Some airlines will do better than others. So I think it just feels like a more normalized market. I suspect that in 2024, that growth drive that came from the recovery will probably begin to plateau and get a more modest kind of gradient on it, which I think is appropriate. I don't think you can continue to grow our industry as it's been growing in the last couple of years as it recovered. And I think you're going to start seeing, as we have pre-COVID, there'll be some airlines will do very well and have good strategies and execute well. Others will probably, stumble along the way, and I'm sure we'll see some airlines, not doing as well. But that's not going to be because of the macro stuff. It'll be because of, individual strategies, individual markets. So I think it's kind of back to normal is how I describe it.
Yeah, which I think everyone would probably welcome after the last few years in dealing with the run-of-the-mill problems. And maybe if take that as demand side, very strong, and we've seen that consistently. As you say, we're now seeing it across most geographies. Supply side, very challenged. You guys obviously are a very large order of new aircraft. Can you talk to us a little bit about your concerns? And let's focus maybe on the OEM side, on the airframe side to begin with. Can you talk to us your perspectives and where they sit from, a production rate perspective, and also the challenges that may be giving to SMBC as you look to grow?
Yeah, I think the challenges that the OEMs, the airframers face are well known. I mean, some of them I would say are probably own goals, and some of them are driven by the overall macro situation in terms of supply chain. I think the industry has learned it's much easier to wind the system down than wind the system back up. I mean, our view has been for the last 12 or 18 months that this is going to be a continuing challenge for at least a number of years. I mean, I see it going well out into 25, 26 and possibly beyond. And that brings challenges for us, but it brings real challenges for our customers, because if you're an airline and you're planning to sell seats, knowing you're going to have an aircraft is probably the most important part of it. So having to I suppose manage that dynamic between the manufacturers on one side and our customers on the other is challenging. I think we've all gotten better at it. I think expectations are probably a bit more adjusted, I would say, for what's gone on over the last 12 months. And I think people are increasingly, I suppose, recognizing that, look, if an airplane is going to be there in X, there's a risk to it that's going to move to the right, and we need to manage for that. But it is a continuing challenge, and it's a real challenge for our customers in particular. It does obviously present opportunities for us, because as a big aircraft leasing company, we've not just lots of new aircraft, we've also got lots of used aircraft. And so we're seeing, extension rates are, the percentage of aircraft that are getting extended has gone way up. So most airlines are keeping, if they have an aircraft, they tend to keep it. And those airplanes that are coming back, we generally find they're getting taken out of the, picked up by their airlines quickly and at good rates. So it does present a challenge, but also obviously as an aircraft owner, it presents some opportunity. So there's, it's an interesting market at the moment. There is definitely supply side challenges, but also there's real demand side as well. So it's quite a bit of push and pull in terms of what's driving the market at the moment.
And your perspective on how much the engine difficulties are going to exacerbate those supply side challenges?
I think significantly, obviously particularly for the GTF. I mean, that's a significant challenge. We hope and believe that we know the extent of that at this stage. I think our customers are all, I suppose, coming to terms with what it's going to mean for them in a practical sense, in terms of AOGs, in terms of shop visits, in terms of inspections. And it's going to make 24, I think, a challenging, 24 and into probably the early part of 25, a challenging environment for some of those operators. Having said that, I think they're all, they're realistic and recognise that this is a period of time. It's a manufacturing as opposed to a design issue, and it's something that can be addressed and ultimately will be addressed by the manufacturer over the next 12 to 24 months. So it's definitely a downdraft on the industry and on the market, but it's certainly one I think you can kind of bookend of it, and we kind of know what it's going to look like over the next 2 years. Not good, but at least we know what it is, and we'll manage through it.
And you mentioned how that demand piece is driving opportunities for large lessors. Maybe get your perspectives across two pillars of that. One on asset values and whether or not you're considering more asset sales given that heightened demand environment. And two, just how you're seeing lease rate factors evolve in this environment.
Okay. Well, look, I suppose maybe I'll start with the second part if I could. I mean, lease rates have improved, okay, markedly. Compared to this time 12 months ago, lease rates are up 20, 25, 30% in dollar terms. And that's driven by a number of factors. Interest rates have gone up, obviously, so interest rate is a big part of any lessor's cost base, and obviously as our costs have gone up, we'll have to pass that on to our customers. But also the demand side. So they're less for the reasons we just discussed. There is more demand for airplanes because people are traveling more. Airlines want more lift because they see opportunity, and yields are good and pricing is good in many markets. And also there's less supply of aircraft because of the challenges in manufacturers. So we've got those dynamics are pushing up lease rates. And because of that, then I think people are looking at aircraft values in terms of where airplanes are now generating more revenue, that tightness in the market in terms of supply demand, we're seeing that flow through into the values of aircraft. So aircraft values, even in a higher interest rate environment, I think are strong. And that's obviously informing how we think about our aircraft trading. We've an active, as we know, we've always been an active trader of aircraft. And we've an excellent trading team based around the world. And we will lean into that market if we think there's good value represented in the market relative to the long-term cycle. We will find that value and we'll trade aircraft. You always try and strike a balance, but if prices are good, we will continue to trade into that market.
And the impact that interest rate environment is having on your business. Can you talk to that? I guess even last year we were in a situation where rates were going up, and it's probably the volatility of those rate increases or what caught people a little on the hop. Your perspective on, is it higher for longer or in a period of kind of settled, or what's your outlook?
Oh, that's a good question, Joe. I mean, I think it's hard to, I mean, look, frankly, it's hard to know. I don't think ultimately anybody really knows. I do think my instinct is that inflation is going to be stickier and more going to stay around longer than other people might like or want. I don't think it's going to be at the levels it was, say, at the start of this year, but I do think it's going to be, you know, at a more elevated rate than we've been used to for the last decade. I think that's going to be reflected in interest rates. So I would probably be in the higher for longer camp. I don't think that necessarily means they're going to stay exactly where they are, but I don't think we're going to see 1-2% interest rates for quite some time. So I think you'll be in or around the current zip code for the foreseeable. And that's, you know, and that's going to have an impact on lots of businesses, not just in our sector, but I think that coming to terms and managing a business in a higher interest rate environment than people have been used to for the last 10 years, I think will bring challenges. It'll also bring opportunities, but it will certainly bring some challenges for right across our sector.
And maybe honing in on the debt market more broadly, if we are in that higher rate environment, your perspectives on the health of the aviation debt market, and that's probably looking across the piece to the traditional banking market, the unsecured market, which you guys, you know, regularly tap, and an area that probably doesn't touch your world directly, but those alternative lender class, which is probably increasing. Yeah,
I think it's certainly not as flush a market as it was. I think, you know, money is more expensive, so I think there seems to be less of it around. Certainly, the bond markets are. You know, we're in the market twice this year. I'm glad we traded when we did, because I think we got in at a good time. I think it's a bit choppier at the moment. Again, we tapped the bank market for acquisition last year. The alternative market, as you say, we don't need to tap it a lot because we do all investment grade secured lending. But I do feel that's a more challenging market from what we hear, and even from our trading partners who might go to that market. I think money's definitely more expensive and there's less of it around. And I think what you're going to see in the market, in this interest rate market, I think it's going to become a bit more bifurcated. I think there will be a big difference between strongly rated, strongly backed leasing companies and those that perhaps don't have that financial strength and that rating. And I think it's going to be a more discerning market. I think when the spigot was open, so to speak, for the last 10 years in terms of the monetary policies, you know, money was abounded for a lot of businesses, and you know, but I think money is getting a bit more selective about where it goes now, and I think you're going to see that, you know, that there will be more of a flight to quality, and I think that's a good thing for our business. I also think people are paying more attention to interest rate risk management. I think, you know, when you had a very low flat curve for many years, you know, I think hedging became a less of a thing. Now, we've always been a very prudent hedger of our book, so we always matched our assets and our liabilities. We've got a funding gap of less than a year, so that means our average lease and our average funding liability is less than a year between them. Again, not everybody has done that. I think that will, as interest rates rise and people need to refinance, that will have an impact on people. So it's definitely overall a more challenging capital market, financial market than it has been for some time, and I think we're going to see that play out over the next couple of years.
Yeah, and that probably speaks as well. I know we were honing in there in debt, but probably to the investor class as well. And interested in your perspectives there, where you've been backed by, you know, strongly by Japanese capital. Japanese capital's been at the space a long time. Challenges with the dollar, with that market. And then, you know, some challenges, I'd say, around US private equity and maybe some of the structured product they went into not giving the returns they'd hoped for. Your thoughts on how the investor market on the equity side is maybe evolving in this heightened interest rate environment, and just the general volatility that's out there?
Yeah, I think it's a great question, Joe. The market is definitely adjusting, okay? So again, I feel it's kind of like a subset or a same theme as what we just talked about. I think the market is adjusting to what's a different regime, a different kind of environment. And I just don't think it's not as deep as it was. And I think people are just being more selective. So I think people are more selective about the types of assets they buy, the types of counterparties they do business with, because they can be. And you know, so I think you're definitely seeing it's not as deep a market as it was. But you're also seeing new players coming in all the time. We've seen that in some sovereign money coming in, new sovereign money coming in this year. I think you're going to continue to see that cycle. So it's just different pools of money moving in and out, but it's probably not going to be as liquid as it was, say, I would say at the kind of the zenith, maybe just pre-COVID, when money was cheap and there were lots of people in the market.
And can I get your perspectives maybe on the macro leasing environment? As we've been having these conversations over the years, we talked about that 50% threshold of leased assets, clearly breached now, and maybe during COVID was mid-50s, potentially higher, and particularly around new deliveries. You mentioned at the start, airlines generate a lot of cash, and probably a nice problem for them to have, but probably opens up considerations for them and how do they deploy that cash. And I know some balance sheets still remain stressed post-COVID, but do you think the way airline performance is going and how they are generating a lot of cash at the moment, that we might see a tick backwards in that lease percentage, or how do you perceive that?
Yeah, I don't think so. A couple of comments I make on that. First of all, yes, they are generating more cash, but we've just done some work actually looking at airlines' balance sheets pre-COVID and post-COVID. There is still a significantly higher level of leverage than there was pre-COVID. So I think there's still quite a bit of a journey to go in terms of getting back to where airlines' balance sheets were beforehand. And you see that in ratings, and you see that in borrowing costs and lots of things. Will some airlines have more cash and be likely to buy aircraft? I think some, but it's not going to be a huge number in my view. It'll be probably some of the usual suspects. But what I think is also very true is that I think airlines learned the lesson during COVID that, as one of them said to me during COVID, he said, one of the things I have learned during the last couple of months is that, you can pick up the phone to your lessor and have a conversation with them. You can't pick up the phone to the bond market and tell them your cash flow is crimped and you got to take a bit of a break and do a rescheduling. So I think that has not been lost. So we're actually seeing customers now, airlines who typically would not have done operating leasing, looking more at that market, and not necessarily doing everything in the leasing market, but doing some. So I think, yes, there are more cash generating. There's more cash generation in the airlines, and some of them will use that to finance aircraft. But I think on the other side, some of them also recognise that hedging some of your bets, spreading some of your risk, taking the residual risk off your balance sheet, those are good things as well. So I think net, I think we're still in a market we're going to see I don't think it's going to go through the roof, but I do think it's going to steadily, the market share of leasing will continue to be stable and probably increase a bit in my view.
Yeah, and it's interesting, that deepening of relationships point, which I know we talked about in the past, as you say, the huge levels of support the leasing community gave and keeping all airlines going. Curious on your thoughts on how that quid pro quo works now around, you say airlines are out there now looking for a lot of increased lift. When you're looking at lease extensions, or now you've got the nice situation where people are knocking on your door for assets, I'm sure price is number one, but how near does relationships come into that conversation?
Relationships is important, and look, ultimately I think you have to be transparent and fair to your customers. And look, I've had these conversations in the last few months with people I've known for a long time, and they say, Peter, why are you charging me X $1,000 more? And they say, look, I've got shareholders, I've got interest, I've got responsibility to my constituency. We like doing business with you, but that's the market price. So relationship is important. I think you can be a bit more choosy, I suppose, in terms of who you might place an airplane with. I also think you can probably, it's not just rate, but also some other terms you can probably tweak a little bit and get a little bit more back. Because these markets, they're strong and they're weak. The benefits or the negotiation position tends to wax and wane a bit over the cycle, and we're at a position at the moment where we have probably more to play for than we would have had, say, during COVID. But we also recognise that's a cycle, and you don't want to, you want to make sure that you live to fight another day, and you don't. So the relationship is important, but I've got shareholders and investors, and I want to make sure I get a decent return for them as well. So that's our job.
And bringing you back, maybe one of the points you mentioned on the leasing side is we might see something of a bifurcation of that market, arguably the haves and have-nots in relation to investment grade and not, and those that are able to play in narrow-body new tech space because they have a cost of funding that can support it, whereas maybe others that move into the niche side. That would, if you follow that thesis through, it speaks to fewer, larger lessors. Do you think that's where we're going?
I think in the longer term, yes. I think what you've seen, you've seen some M&A activity over the last few years, including some, we did an acquisition, a significant acquisition in fact, almost exactly 12 months ago we closed. But I think you're going to see more of that. As you said, I think, the this is a more commoditized, a more scaled industry. It does make a difference. Investment grade makes a difference. Ability to raise capital at a competitive rate makes a real difference. And I think, compared to say 10 or 20 years ago, when say 25 years ago now, when we started this business, I think the barriers to entry are whether to get a leasing company going isn't, you can get that doing, but getting it to scale has become harder, I think. And I think that's going to continue. So I think that in 5 or 10 years' time, you're likely to see a smaller number of large lessors, one of which will be SMBC Aviation Capital.
Maybe shifting gears, Peter, around ESG, and I know it's an area you guys have put a significant focus on across the piece, the ES and the G.
Yep.
Do you want to talk to us maybe a little bit first on the funding side? I know you issued your first sustainability-linked financing earlier this year. Some people would look at aviation and say, how can you ever have sustainable financing in aviation? Do you want to talk to us a little bit about the traits of that bond?
Yeah, sure. And look, it's something that we put a lot of thought into doing it, because I'm very conscious that these things can be called out or attacked, whatever the word, for greenwashing or other things. But we also felt it was important, so we wanted to make sure we weren't doing that. We also made it important that we take the first step in that journey, and we try to, create financings and structures and incentives for us to do better. And we are very, as you said, very focused on all the 3 letters of ESG. So in this, in this transaction, it's carbon intensity of our fleet. It's how how good our fleet is. But also we've also put an S element into it, which is around diversity, gender diversity in our business. So we're trying to combine those things. Is it going to move the needle hugely? No, of course it's not. But it's a step in the journey. And I think around all these things on ESG, it's easy to be cynical about them. It's easy to say, it doesn't have to make any difference. But we've got to start the journey, and we've got to start doing things. That's why we've invested, for example, in carbon credits. That's why we're looking at things in relation to SAF. That's why we've committed to IATA 25 by 25. They're not, in of themselves, it's not going to change the world. But I think, if you add all these things up, they do add up to something, and that's what we're trying to do. And
obviously there's a general good intention in doing those things, right? There's also making sure that you're making the right decision for the business. The pressure coming from either debt investors or your equity investors to push that agenda, how strong is it?
I think it's certainly strong from our shareholders. We're very aligned with our shareholders around all of the ESG, and they are very committed to it. It's important, and if you look at their strategies and their, what they've said publicly, all of our shareholders have been very public in wanting to do more and are doing more in that regard. So it's motivation there. I think it's important in the debt markets. Some markets it's more important than others. It tends to vary a little bit. For some investors, it is important, and you gotta not just tick the box but have substance. Others, they could take it or leave it. But we're doing it not for that reason. We're doing it because, one, it's the right thing to do, but also it's good for our business. This is good for our business. We want to future-proof our business against, the challenges of climate change. We want our business to be sustainable. We want to have a diverse, inclusive workforce, a diverse and inclusive customer base, because we think it's good for our business. It's good to do, but it's good business in our view, and that's why we're doing it. Yes, it's obviously important to our various stakeholders like equity and debt stakeholders, but it's good for the business.
And last point around maybe that ESG point, the key building block to our reduction or a path to net zero is clearly SAF. Can I get your perspectives as you think about, someone who runs a very large group in aviation finance and has lots of skills in, raising capital and investing in assets? Do you think we could see, portions of the aviation finance community move into that space to try and supercharge an agenda that really needs to be supercharged?
Yeah, well, we talked about this yesterday. There was a very successful Aircraft Leasing Ireland Sustainability Day yesterday, which I and a number of my peers spoke at. It's a very good day, very well attended. But we did talk a lot about that, about how we can actually make a difference in SAF. Because I agree with you, I think SAF is the pathway that we can make the most difference on as an industry. And I think well-capitalized businesses like ours, particularly with shareholders like ours. So if you look at our shareholding group, they have a lot of expertise in project finance, in energy markets, in making markets around different types of commodities. So that skill set that financial strength, our knowledge and expertise of the aviation market. I think when you combine those things, there should be a role. I mean, in fact, I think it's not just there should be, but I think it's incumbent on us as a entity, as a group that has those skills to really have a serious look about how we can accelerate SAF, how we can make it more accessible for lots of a wide range of customers, how we can help get it financed, how we can help it develop. So there's lots of things we can do. For example, in our new offices, which we're moving into in a couple of months, and we're going to have a joint venture there with Trinity College Dublin in terms of a SAF research facility. So there's lots of things we can do, small and potentially in the long term big. So I think there's a real role for strong financial backed institutions with aviation expertise to play a role in SAF right across the value chain.
And Peter, maybe in closing, as we look at the broader market, the demand opportunities, the supply challenges, as you say, always macro issues that are out there. What are your optimism levels like as you look out into 2024?
They're good, Joe. I mean, I think it's been a real roller coaster for the last number of years. As I said at the outset, it feels more normalized. I think my optimism for our business, SMBC Aviation Capital, is high. I think we have gone through a very challenging period. We've taken, I believe, advantage of the last number of years in terms of consolidating our position, improving our fleet, getting some great new people into our business, strengthening our processes and our risk management. We've done a lot of things over the last 5 years that's going to make it'll make our business better. And I think our business is proven to be very resilient. And I actually think our industry has proven to be very resilient. So for our business, I would be very optimistic about that we're going to have that we're in a decent place. There are always challenges. Hubris is always a risk. But I'm confident about where we feel at the moment, where we are at the moment. And for the wider industry, again, aviation has proven to be exceptionally resilient over what's been a very challenging number of years. It's very clear that aviation travel, air travel, is something that people want to do, that it is a force of good in society, that it generates a lot of economic activity. It builds bridges and connections around the world between people, which at a time like this I think is really important. So I think aviation is generally, it has its challenges, not least on the sustainability side, but it's generally a force for good in the world. And I think that gives me cause for optimism, because I think it's going to continue to play an important role in the global economy and contribute in a positive way to the global economy, notwithstanding some of the challenges that we'll always face because of the nature of our business.
Well, Peter, on that hopeful note, I would like to thank you on behalf of KPMG and Airline Economics, as always, for your excellent insights, and wish you and SMBC Aviation Capital a very successful 2024.
Thanks, Joe.